Hello, credit union executives. Welcome to See You on the Show, where we give you up-to-date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. Welcome to today's podcast. I am excited to introduce our guests, Jeff Klein, Omar Jordan, and Kristopher Kovacs. All three of these guys are prominent figures in the credit union movement. I think they're known for their innovative ideas and leadership. In this episode, we're going to have a discussion of bold leadership in the credit union movement, talking about working with fintechs and how to deal with change in the system. So get ready for an interesting discussion. Let's get started. Jeff, Chris, and Omar, I'm delighted that you could join me on See You on the Show today. We're here to talk about bold initiatives, bold leadership in the credit union movement. But first, tell us a little bit about you. How did you get started working with credit unions? What is your connection? What is your emotional connection to this movement that we think so much of and want to drive forward? Why don't we start with Omar, since he's the one that got this idea started?
All right. Well, boy, if it wasn't for credit unions, I wouldn't be where I'm at today on a personal level and on a professional level. I remember just having a high interest rate personal loan debt, unsecured debt, where looking for ways to pay it down. And a credit union reached out and said, we can do it better. My first car loan, a credit union. My first house loan is a credit union where I was turned down everywhere else. Credit unions took a chance on me as a member every time, every chapter of my life. And I feel like I owe it to the industry to give back somehow with what I do today, which is building technology that allows them to compete in the landscape of fintechs that want to go after their members. And it's an intimate relationship between me and credit unions, and I'm grateful to be in the industry.
Yeah, thank you, Omar. Chris, why don't you go ahead?
Doug, thank you very much. So I've been in the industry 3 decades now. And in that experience, I do not count the fact that when I was very, very young, probably 4 or 5, my father was a deputy sheriff in Fairfax County, Virginia. My mother was a nurse. And when they had to swap me, hand me off sometimes between shifts, they would drop me at my grandmother's, who worked for Navy Federal. And when I was 4, I would stamp loan paperwork on her desk, waiting for her to be done so that we could go home and would get into whatever 4-year-old Chris got into. So I'm a legacy, credit union legacy. And from my perspective, I have worked almost entirely within the industry and just adore it. Worked through college and obviously all the way up until today. So credit unions mean a lot to me. Today, I'm the president and CEO of Constellation Digital Partners. We're a CUSO that was spun out of Coastal Federal Credit Union when I was there as the CIO. And we offer an open digital platform for connecting fintechs and credit unions today. So thank you very much for having me.
Chris, let me get this right. You were approving loans when you were 4 years old. Did I hear that right?
No. Disapproving, stamping disapprovals. I'd get a stack. She'd give me a stack of loans, right, that needed to be disapproved, that had already been disapproved by actual adults in the room. And my job was just to stamp them with the big red disapprove stamp.
Wow, there's a lot of those available to you, huh? Interesting. Well, go ahead, Jeff.
Well, Chris, now that makes sense. That I heard the 3-decade thing last week, and now that I know you started when you were 4, now it all makes sense. And yes, I have Chris beat. I will just say more than 3 decades. And honestly, I could talk about this for 10 minutes. But my start in credit unions, I was just one of those hotshot young auditors that worked for one of the big 8 accounting firms back, and there were 8 of them. And one of my clients was U.S. Central Credit Union. So anyone who's been around more than 15 years remembers U.S. Central. And so it went from finance to finance. And so not a very heartwarming story, but as I traveled around and got to know all the corporate credit unions and the leagues, I finally went, what's this natural person credit union thing? And started checking into that and said, yeah, I think I'd like to try that. This feels like a place I might be able to make a career. I was blessed that my first CEO came from a smaller credit union where he was in the HR department at Dillon Food Stores, and they started a credit union, and he went from HR to being the president of the credit union to being president of 66 Federal, where I started my career in my first natural person credit union. So it was a blessing, not only because he really believed in credit unions and believed in the philosophy, but he had that HR background. And so as at that time, 26-year-old that was asked to run his branches, I was a CPA and worked at US Central. The whole credit and philosophy thing didn't make it up to US Central. So it was a real blessing to get to work for someone like that. It's my first foray into credit unions. And it really helped me see the other end of the spectrum, focusing on people, helping people, and driving culture and leadership. So I was very, very lucky.
When we set up this podcast, we put out a bold idea, and that was that we were going to talk about what bold leadership means in the credit union movement. And I would say, and why that's important. So who wants to go first? Maybe Jeff, since you've just warmed us up, keep on rolling. What does bold leadership mean in the credit union movement, and why is that important today?
Well, I'm not sure. So first, two things that popped to my mind don't feel very bold, but they feel foundational. One is you really got to lead culture first. I think the next thing is that we really need to educate our board. And again, this is not very bold, but I hear over and over and over again that most credit unions, the board can be an impediment, or they're just sort of rubber stamping, if you will. And my attitude is, if you can really educate your board, bring them up to a level where they really understand your business, it does a couple things for you. One, they recognize when you're kicking ass, right? If you're doing a great job, they'll recognize it. They know the difference. And I think the second thing is that you can be bolder. You can make bigger decisions, and you can take risks instead of, a lot of times the boards, they hear from the NCUA about what their job is. And if they can support your ability to take risks, because really to me, that's the third thing, is we really need to take more risks. As an industry, it's like if something fails, we did something wrong. And my attitude is, if nothing ever fails, you're not pushing the boundaries enough, because we've got a lot to contend with here. And if we don't start taking some chances, and quite honestly, my definition of risk might be different if I was the CEO of a credit union, but I have done that. And I think when we take risks, they're awfully small bets. I would love to know the last time somebody said, I'm willing to run at break even this year in order to move this initiative forward, and I'm going to give up 100 basis points of ROA, or I'm willing to settle for 60 basis point ROA for the next 3 years in order to push this initiative that's going to make a difference for our organization. I'm sure there's some people out there that have done that, but that's a really, really, really small percentage.
Very well said. Very interesting. Making sure the board is educated, of course, very much also goes into if you are considering changing jobs and the recruiters are calling you when you're looking at where you might go, that making sure that board is deeply educated gives you the springboard to take more risk and boldly lead that institution forward. That is a great takeaway. Omar, Chris?
Jeff, I am curious from your perspective, and maybe for Chris, since you have more experience in this space than I do, can a CEO of a credit union be selective to some degree as to who sits on their board? There are, and I think maybe before I even go any further, let's just say to whoever is listening to the podcast that this is all about transparency and just calling it what it is. There are board members that go to GAC for the free pens, and there are board members that go to GAC to be strategic. And so can a CEO be selective and resurface or surface up the ones that he or she are targeting to be on that credit union's board?
Omar, what I would say is remember that a board member is elected by the credit union membership and not by the executive team, right? Hire the executive team to be able to do that work. That having been said, I've seen credit unions who prioritize the type of involvement, and look for the type of involvement in potential board members that would be more indicative of somebody who was going to push the organization versus corralling a group full of nominees who were there for the chicken dinners. It's really a partnership between the CEO and the chairperson to really define kind of what's the culture of the board going to be. And then ultimately, I think it's really the responsibility of a credit union board chair to drive that culture into the board itself, right? It's certainly, the CEO can be supportive, but it's not the CEO's job. The CEO's job, though, in working with the chairperson should be to develop the next best version of the board. It's a little bit different than where you and I sit, right? and you in particular as a startup, right? Is, in a startup world, we try to find people who can add some piece that we don't have inside of our company to really help us drive our business forward and to drive to those new things. I've met board members who do exactly that for credit unions because, obviously I've spoken to a lot of credit union boards over the years, and I've met some that don't. And I think, it really, in the end, it's a matter of what's the culture that the chair and the CEO want to create. They're out there. They happen to be many times for state chartered credit unions that actually pay their boards. They tend to be a little bit more startup-like in some cases. So that's that's part of it. Board members give up a great deal of their time and effort to participate inside the credit union governance structures. And in my opinion, one day, I think if we want professional boards, they should be paid.
Hear, hear.
Do you guys have any feeling for how frequent that is seen in the credit union movement? Paid boards?
Well, my understanding is a federally chartered credit union can't do that. So that eliminates a good swath of them. I would have to guess that maybe 15 states probably allow that. And I would suspect that not all the credit unions in those states take advantage of that. And the ones that do, what they do is all over the place. I've seen a credit union that just offered healthcare benefits for its board members, which is not a bad thing. I've seen some that might offer a couple grand a board meeting, or so much for a board meeting, so much more for the chair, so much for committee meetings, which to me feels like it aligns really well with what happens in the corporate world. Again, my 3+ decades, I've been in 6 different boardrooms, and it's all over the place. How they move, how they govern themselves, how they hold each other accountable, how they improve and strengthen. And I've been in some phenomenal boardrooms, and none of them were being paid, but I've been in some incredible boardrooms. I wouldn't say I've ever been in a bad one, but I've been in some tough ones that migrated towards better.
I wonder if there's some data on that to say 15 states, X amount of credit unions, this is what came out of paying the board. Because I feel like, to your point, a federally chartered credit union does not allow for that, but it's 2023 and business is done way different than it was. And therefore, some of these things could be revisited, maybe if the data shows a proof of is in the pudding, so to speak.
So, Omar, I would say the proof is not today. I think one of the things that, paid or not paid, we really have to align metrics and performance. And there are some great boards who are not paid, and I'm sure there are some great boards who are paid. If you put that in place, and let's just say you have a very mediocre board and you put in, hey, if you think you had a problem with board members staying a long time before, wait till they're getting paid. I mean, most of them stick around for the free trip to Hawaii, that's not fair to paint them all with the same brush, but we'll just call it the stereotype, and stereotypes are a stereotype for a reason. But the longevity of getting to go to Hawaii once a year or whatever, and they may do, and again, that's not to condemn the quality of work that person does, but the point being, does the board have term limits? Does the board, do they have performance expectations? Do they have performance evaluation? Does the nominating committee take those things into consideration when they're renominating at current board members? And there's a lot of things. I don't want to turn this into a board member conversation because that's not fair. That, there's a lot of other leadership issues. But
I was going to kind of step off of the board train as well. And here's why. I like the idea when you're thinking about bold leadership to start with the board, because the board's going to grant their CEOs some degrees of latitude. They're going to say, hey, it's our expectation that, and they set the expectations and they do the evaluation on the CEO for how they have done their job or not. The opportunity, I think, is for the board and for the people who hold those roles as CEOs to really push beyond the boundaries of where we are today. We tend to start with, well, here's the economic performance we want to do, and then we back into the rest of the business. The challenge with that is that that's always playing from the back of the field. We were sitting in a meeting last week in regards to an MDC thing with Jeff, and one of the things that popped in my head is it was like, we haven't had a new product since debit card.
And we didn't invent that, Chris. We followed somebody else.
I know, but we as an industry don't have a new product since debit card.
Now, Chris, I would say overdraft protection is newer than that, if you call that a product. not to split hairs. So much more innovative.
Not to split hairs, right? If we're not giving permission to the leaders who are out there thinking differently to drive the entire industry in new directions, we're always playing with the last set of products somebody else created, and we're trying to play catch up. We're not leading. We don't understand the economics of it in some cases. So what I see a lot of today is we're following, we're not leading. And that's where, and I wonder if, because of our lack of innovation from a product perspective, if we aren't tapping out, reaching our fullest potential for growth from that perspective, while you have new folks come in like Chime and others who completely refactor it. They come from a first principle standpoint, like challenge every assumption, begin with a completely blank slate. We're so tied up in what we've done in the past that we're unwilling to let go of those things to try new stuff. Right. I mean, we have conversations all the time with folks who are like, well, I want to do all these new things, but I can't let anything go that I've ever done before. And that's not a recipe for success.
Well, it's what's sad, and Chris has heard me say this before, but we were a disruption. Creation of credit unions was a disruption. We've done a handful of cutting edge things, but for the most part, for the last 50 years, our innovation was just bringing the next banking product into credit unions. None of you can probably remember when share drafts were new and everybody fought over whether if you called them checking, you were a heretic. You know, it's like, no, they're share drafts. And that's just our innovation. We bring in mortgages, we bring in HELOCs, we bring in debit cards and overdraft protection.
So, Chris, when you say we, and you're right, this is not necessarily an industry where the board necessarily runs the credit unions. The question is, then who runs that credit union? And if it is the CEO, then who allows the CEO to create these products? Is there a governing body that prevents us from creating the next big debit card technology or concept?
That's an interesting question, Omar. I think the opportunity is for folks at the board level and into senior and in senior management to really focus on things like product management and product development, right? We've got a lot of folks in our industry who have product manager titles.
And the definition of what that means is miscued.
Well, they manage products.
100%.
Yeah, it's not product development.
They manage products created by other people, and they just try to replicate them.
And then they somehow get creative with the interest rate and $5 here, $5 there, but a true innovative product that's never been done before.
That's right. Or taking an existing product and repackaging it, right? Like Chime's credit builder solution is just a charge card. Those have been around since the 80s. But somebody repackaged it, rethought about how to use it, said, hey, how about instead of making a transfer every month, I make a transfer every day? Oh, it's almost like a secured card then. It's super easy. We don't give ourselves enough slack to really be thinking about those things. And then, oh, by the way, having the idea is one thing, and then putting it into practice and then making changes to it based on scientific observations that are occurring inside of the actual release process. That's product management. And I have yet to see an institution that's really pushing the boundaries like that. And I just worry that if you look at who the fintechs are really working with and who they're capturing all those young people, right? They're capturing that digital first generation. And we're playing with a side of the deck that's not stacked in our favor.
Yeah, we've had 30 solid years of successful growth. Our assets have grown. I think it's something in the neighborhood of 9-10% compound over that period of time. And we haven't gotten any more efficient. Sort of, you have this opportunity to go, we have gotten this big, and because of that, we should be now twice as efficient, or even 10% more efficient. We've lost interest margin. There's a painfully negative trend line on interest margin over the last 20 years. And if you include the 90s, it's even steeper because the 90s were just phenomenal. We've gotten more efficient at a substantially slower rate. And so our margins have shrunk faster than our expenses. We're like the proverbial frog in the water, and the water's getting hotter and hotter and hotter, and we don't realize it. And pretty soon we're going to be somebody's frog legs. So we need to figure this out, and we need to do something. That guy I told you about that came from HR used to say to me all the time, and I was literally 26, and I thought he was crazy, but he said, it's what you do when you don't have to do anything at all to get you where you want to be before it's too late to do anything to get. The game isn't over in the next 5 years, but in the next 5, 10 at the outside, it's going to be too late to do anything to get there. And it's time for us to do something.
Yeah, the legacy investment that people are making inside of artificial intelligence right now and data analysis are years in the making, and we haven't even started yet. That's what's scary to me. And that's going to accelerate because Jeff's right. We've had growth over the last 30 years, but are we getting a larger percentage of market share? not in any reasonable way.
Yes, I mean, probably a teeny bit, but assets have grown 9%, members have grown 5%. So we've had some membership growth. It'd be deposits per household are a little higher, et cetera, et cetera. But it's just this little incremental, little more of this, a little more of that. We have more delivery channels and more expense.
The question then, Jeff, is how do credit union boards encourage CEOs and leadership teams to be more bold?
In reality, let's face it, most credit unions are led by the executives, and they bring the board into the conversations. And for the most part, the board supports what the management does. Again, generalization, but generally true, especially at the bigger shops. Once in a while, the board may get in the way, but most of the time, if we bring our board into these conversations, the ones who are doing it, I think the board's very supportive of them being at risk here. I think for us, I mean, let's face it, success in financial services isn't about who made the greatest innovation. It's who makes the fewest mistakes. We're highly regulated, NCUA. You know, when you talk about who gets in your way, Omar, if people are getting in our way, it's the NCUA and it's the board. But that most of the time, I don't think we are being bold enough. And so I think that when you got a strong board and you got a strong management, we probably are in a position to take more risk than we are, which is sort of what I said earlier.
So on one of my podcasts in the past, I talked to Tom Novak at Visions Credit Union in upstate New York. Actually, that is my home credit union. That was my first credit union many years ago. He talked about the way that Visions has a digital first initiative and has deep partnerships with fintechs, so that the fintech is taking the initiative and the initial risk and having the culture of the startup to try to go from zero to something. And then the scale entity, the credit union, is partnering with them to help them get it to a different level. And it, of course, evaluate it in the eyes of what would impact the member the most. What Chris had said earlier about credit unions taking initiative and developing products, maybe they're not developing their products themselves, but maybe they don't need to, or maybe they shouldn't be because they don't have the right culture for that sort of activity. But partnering with these fintechs, are we not partnering the right way? Should we be partnering a different way in order to sort of have a start? So it goes not from zero, but from a certain level, and then the credit unions engage and potentially get to the same outcome.
So I have two thoughts on that. One, as Chris was describing Chime, and I think we all know this, and when I talk about fintechs, I tend to talk about experience. I feel like that's where we're losing the battle, is on the experience front. Chime doesn't have any products that are radically different than our products, but they out-experience us. And when I talk about fintechs and I talk about credit and business models, you can visualize a Rubik's Cube, which has three dimensions. One is products, one is channels, and one is market segments. And each of those little cubes is a battlefield for us. We do car loans for millennials via mobile. That's one little cube. And then to boomers and on and on and on. Every one of those little cubes has got at least 10, if not 100 fintechs coming after us. And they beat us because of their experience. We have bigger balance sheets. We have members, right? So it's a war. And it's like, I don't know what you compare it to, but it's like we're a rhino and there's a trillion ants out there. I don't know if a trillion ants can hurt a rhino, but the point being that all these little critters are coming after us and they're nibbling away at each of those cubes. And they're doing it because their experience is better. As it relates to working with fintechs at Members Development, we started Circle Fund and the Circle Collective. And we did that because credit unions are different than fintechs. We don't speak the same language. We don't understand each other. We could go off on Silicon Valley Bank and how many of those fintechs knew what kind of risk they had in their bank. Can they read a bank balance sheet any better than Jeff, who's been is a CPA and a credit union CFO? Can I read a fintech's income statement, know what it's telling me? No. And so that's just one part of it. We don't, when a fintech comes to a credit union, if we're lucky, the right fintech finds the right credit union. But most of the time, the right fintech finds the wrong credit union doesn't know how to speak fintech. And if they find the right credit union who can speak fintech, then there's the possibility that Omar comes looking for me and he needs help. And I love what Omar does, but if that's not on my strategic plan for the next 2 years, then he's got to go see if he can get lucky enough to find. And so that's what the Circle Collective and the Circle Fund's all about, to be that intermediary who can speak credit union and speak fintech and go, I like this technology. And they're not trapped to, this is not on my plan. This makes sense for credit union. And that helps facilitate us finding each other.
By the way, I feel like we should say, for those who are joining, Jeff and I are in New York. We're the crime rate is extremely low, hence the sirens in the background.
I would add on to that question around partnering with fintech. That's why Constellation exists, right? We were started for the specific purpose of answering the integration problem. So we see hundreds of fintechs, and I'm actually very, very hopeful that credit unions are doing a better job partnering with fintechs, right? I've seen it with Circle. I've seen it with Constellation. I've seen situations where credit unions are no longer holding things out and saying, hey, if you can't pass every due diligence element at the same level of one of the big providers, I'm not interested in doing business with. When I first started in this, that was kind of the script for how those early interfaces were happening. But today, I think credit unions have a much better understanding. This is, listen, I can protect data, I can get a service, I can do it. And now with Circle, right, I can get funding for that, so that this fintech startup will be there in the future for me to continue servicing members. I think that's good. The challenge is, to some degree, we're still operating like we're playing one-dimensional chess, right? Oh, we're going to take 3 services this year and we're going to integrate 3 services. That's not fast enough. You need to do 9 this year. And then next year, rip out 3 of those that didn't work and put 5 more in, right? Like, that's got to be the pace of innovation to really be bold, is to try it out. Because the other part of it is, and this is something I'm passionate about, not everybody at the credit union should be able to request a new system or service. Like, every year during the budgeting process, right? Every year during the budgeting process, every VP walks in and says, well, I can't get my job done because I don't have the right system. So, and in reality, they'll do a business case. They'll say, okay, get me this system. Here's what I could do with it. And then 3 years later, it's, oh, well, you know what? I can't get the system. I can't get my job done because of this system. At some point, we got to start saying, hey, if you're not meeting your business case, you don't get to ask for more systems.
So, Chris, I have to ask, you've worked for 2 really successful credit unions. And what I see out in the world and what I hear from others is, so I come in and I say, I need this piece of technology and it's going to cost X, but I can now do function ABC 30% faster, right? And so my response used to be, great, then now your goals just went up 30%, right? Now you can produce 30% more loans or whatever X ABC is. And they're like, well, no. It's like, well, wait, you can't have it both ways. If you're going to justify if the reason you're telling me I need to buy this is because you can be 30% more efficient, that's how I justify paying for it. If I don't change the expectations, I can't pay for the system. And those kinds of things happen throughout. Or the converse is, it comes in and we only implement 60% of its capabilities. That's the other thing.
Yeah. So I won't name the credit union, but I was in a credit union once where I had a project to replace a phone system, and then I found out there were 3 phone systems in the building. And then, wait a minute, I'm only replacing one of these? What about the other 2? Right? Like, that's the whole thing. And the reason I say this is because what projects like that do is they suck the life out of your IT team. They suck the life out of your innovation. They suck the life out of your budget, right? And you didn't have to do them, because moving the needle for something like an MRM system or collections or something else isn't really going to move the needle from an experience basis that Jeff was talking about. What's going to move the needle from an experience basis is that new service, that new fintech, integrating that and delivering that. If that's the priority, we can do 9 a year. But if I'm still fighting from an IT poverty perspective, where I've got so little time left after I'm getting all of these requests in for all these new systems, unnecessarily so, then I'm not able to move forward.
Chris, I come from a world where you either perform or you're out, and that doesn't happen in this industry, right? Just thinking out loud. Now, I'm not suggesting that that's the case, but I'm asking the question of, how do we hold people accountable to what Jeff was saying? You've got to deliver results, right? I'm not saying you're out, or, you know what I mean? That's not the way to do business. But how do you arrive at a destination where we can have tough conversations? Because this is a podcast about leadership and moving the business forward. And if you don't hit the objectives and or what Jeff was saying, you want to ask for this piece of technology, well, the expectations just got higher, for example, and therefore I expect you to deliver. And so does that happen, do you think, at the credit union level?
I think so. There's a lot of nuances, and again, you have to generalize, but generally speaking, credit unions set goals. We're going to grow this much, loans, deposits, all those types of things, right? And they perform and they hit their goals and staff get their incentives. And, I've been around long enough to be when setting goals and metrics and bonuses weren't prevalent. And then it became a thing. And then, having incentives for staff. And man, I was, my first job as a CEO, we were a credit union, had like 7 branches and no home office. So the exec team, literally, like some of us were in branch A and some of us in branch B. And this one woman was a member service rep, and I walked right past her every day to get to my desk. And we were 6 months in, and she said, "You know something? I hated you when you started here. I used to enjoy sitting here and talking to the members and having relationships. And you came in and set all these goals, like somehow we're a business that's supposed to make money." But she said, "You know what? I've never worked harder and I've never had more fun when we set these goals and I perform and I get rewarded and I get recognized." So I do think that credit unions, generally speaking, and again, the smallest credit I've ever worked for was probably 150 million, and that was 30 years ago. So I don't know what that translates out to today, but so I've never worked for a small credit union. But the bigger credit unions, they do have goals and they are achieving. I think if you have to go back to it, it's just that we're just doing more and better of the same thing.
I just want to rephrase sort of what I said. I come from a massive corporate America, top 5. So the pressure was certainly on to deliver and this is why I love credit unions, because we do it for our members, not for our stockholders, right? So certainly the world that I sort of started in did not like. This is why I'm here. But what I did enjoy is exactly what you just highlighted, is we have tough conversations. They don't like us as leaders sometimes, but at the end of the day, they're going to love that bonus. They're going to love the experience they got. And there's always a deal of gratitude for that pressure you apply on an individual, because you want what's best for them too.
So we've just hit on 2 things and Chris probably heard me say this last week. I say it a lot, but there are 2 things. One of the best things about credit unions and one of the worst things about credit unions is our volunteer board. One of the best things about credit unions and one of the worst things about credit unions is our not-for-profit status, because it gives us the flexibility to not focus on how many pennies our earnings per share were this quarter, but it gives us maybe a little bit too much latitude to not chase the other side as hard as we could. And that's really in the hands of an executive team and the leadership to go, we're going to set goals that are painful and we're going to work like the devil to get there. And those credit unions exist, but it's not built into our system. It's about the attitude of the leadership. It's not about the system and how we're structured.
Yes, we serve members. Yes, we are a not-for-profit, right? But in the end, we have to do good business for the members. And I think sometimes we can get real caught up on the heart side and our head is weak. And then something comes around like 07 and 08, and all of a sudden, we're thinking with our head now, and our heart's got to take a little bit of a backseat. Although really, I've seen credit unions do amazing things inside of 07 and 08 out of the heart for their members. But it became this is about survival. And I think we have to balance both, right? We've got to do good business. So, there are times where we need to hold people more accountable. And there's times where we also need to give people the grace to understand that the environment didn't happen or there was something else that caused that. But that pattern, repeated over and over and over again, becomes the trend. And what Jeff's talking about from the trends is that our margins are getting tighter and tighter. And we need to start doing some things differently, because the knowledge and the way of doing things that got you here won't get you to where you want to be. It won't solve the problems you created. And I think that's where we've got to focus on trying and really challenging ourselves to do some new things.
Desperation's a powerful motivator. Fear, we only got X years left, blah, blah, blah. And it's the kind of thing that can push you out of your comfort zone and do special things. My fear is because we live off a balance sheet that by the time we realize that we need to be desperate, it is going to be too late to get out of the trends and the death spiral. That's my biggest fear.
In getting ready for this discussion, one of you said something I thought was really, really interesting, which is, of course, the industry is, the average CEO is nearly 60. We're seeing retirements one after the next. And you made the statement that current CEOs need to be doing some things that they will not see the benefit of.
So, I mean, it goes to the saying, right? Wise men plant trees under the shade of which they will not enjoy. And that's where there are investments we have to make as an industry in data in artificial intelligence, we need to start pooling that skill set, pooling that data, like our life depends on it, because I believe it does. It takes 10 years to build an AI model, right, and to train it and do the things that you want to be able to do. And I'm not talking about the conversational chatbot types that we're talking about that we see on most credit union websites today. I'm talking about a fully automated digital credit union employee. Like, if we're not thinking that many moves ahead, we won't realize that to get there takes 10 years worth of work. And by the way, that's almost automatically going to be outside the realm of most CEOs, like final 10 years for them to be able to be there. So our credit union CEOs is the industry going to have enough foresight to say, listen, I have to start hoarding and bringing data together and then making it available for research, or what is that future foundation of credit unions going to be? Because Erica's already been out there and done 1 billion transactions at Bank of America already. We're going to wake up, to Jeff's point, we're going to wake up and realize, oh crap, we should have started 10 years ago doing these things. And that's where I think we need to identify some of those moonshots, or whatever you want to call them, and start putting those things out there so that we can essentially protect ourselves from what will be the inevitable. And that is that these banks these large scale national banks are so far ahead of us where we are going. They're not buying products, they're creating patents. That's the difference. They're creating technology from scratch. And those patents are being cited by people like Google and Apple and Nike. They're so far ahead that people we think of innovators are citing their patents as things. That's a dangerous place for us to try to live. That's where and the structures of today don't work in that way. If I start a QSO, within 3 years, my board's going to look at me and say, well, where's the profits, Chris, right? We were just having this conversation about leading with your head. We're talking about having to make an investment for 10 years that you're not even going to see a product. That's where we need to be thinking about.
Well, and let's bring that back to leadership considerations. What gets measured gets done. So you create goals and metrics, and then you reward people. We talked about that briefly a bit ago. Right. So when you talk about that and you think about, and what I'm about to say is a generalization, but it's a pretty strong one. Not very many credit unions have goals that are more than the current calendar year or whatever. And so I have loan goals, deposit goals, profit goals, member experience, whatever we're measuring, but it's for the next 12 months. Right. So if I come across some innovation that says, if I implement this thing, we're going to, and I'm just making an extreme example, but we're going to be 50% more profitable next year. Okay. Well, the trouble is, if the thing wasn't in my budget, then this year I'm going to underperform my goals because I spent money on the thing that's going to make us more profitable next year. So now I missed my goals. Now, next year, well, in the fall, we're going to set goals for next year, but now they're 50% higher because I bought the thing that said we're going to be 50% more profitable. So all I did was raise the bar for me to hit. And even if I hit it, that's great, but there's no lift for taking that gamble because next year's goals change with the problem. And again, that contradicts something we talked about earlier, but Jesus has a point that if I own stock in a bank, I would make that investment because the value of my stock's going to explode if I can do the thing that's going to make the future generate capital and increase net worth and therefore the value of my stock, right? So that's sort of the best and worst thing about credit union being not for profit. I don't own a piece of the business. So for me to create long-term net worth or long-term capital value of the organization, I can do it out of the goodness of my heart. I can do it because it's the right thing, but my incentives don't align with that behavior.
Yeah, the risk of that is much greater than the potential success, Jeff, to your point. If I'm a chief lending officer, I've been in there for 30 years, then why take a risk at something that's going to potentially put my retirement at risk, right? And so status quo is much safer. And it's not the 30-year veteran's fault. It's the entire industry and the structure in which we operate in. Yes, it's no one's fault. How do you fix that?
I know regulators have the same incentive. Think about whoever the lead examiner was of Silicon Valley Bank. What's his career look like now, right? And not to say he did anything wrong, but the point being, if I'm an examiner and I'm overseeing a financial institution, there's only downside if something blows up and I didn't catch it. And so my job, I'm incented to protect that and be rigorous, not only for me personally, but for the insurance fund I represent. So there's a lot of incentives here to keep us safe. and far away from risk. And so it's not an easy thing to do. And it requires great leadership. It requires the right incentives in order to encourage that kind of behavior.
But somehow we have to figure out, to Omar's point, and to your point earlier, Jeff, we have to figure out how to incentivize the long-term goals, like the really long-term goals. There isn't an equivalent of stock options for employees at credit unions and executives to really drive the value of the organization forward.
You can create them. I mean, you can with a spreadsheet.
No, you're right. And my point, like, that would be something in my mind that, an innovative leader working with their board could create something that really incentivizes the very long-term goals, right? I mean, there are certainly executives in our industry that have long-term incentive plans, but are those really going down and driving the whole company, or are they driving a leadership team who is maybe 10 to 15 years away from retirement? I don't know.
I like what you called out, Chris. You call out what we don't have that causes others to get excited about, right? The carrot, chasing that carrot. And then somehow, somewhere, someone maybe will think about, well, there isn't options for employees or stock options, but could there be? And I don't even know how you do that.
So let me give you a really quick example. I was a CEO of a credit union when I was 31. I had a phenomenal board chair who ran a mid-sized construction company. And he said, you guys should have something like that. So I built a spreadsheet that essentially just mimicked, okay, you have a financial institution, you generate capital, the market value of the institution is 3x book capital, whatever. So you just have this formula. It's just a spreadsheet, right? Well, in the 90s, we were kicking butt. I mean, we were generating 225 basis point ROA year after year after year, right? And so I went to him with a spreadsheet and said, this is how it works. Everything seems right. And I said, but here's the problem. I'm 30 plus years from retiring. If we continue to do what we're doing, when I retire, you're going to owe me $40 million. So we got to scrap this. He said, if you do this for our organization for the next 30 years, $40 million will be nothing. This makes all the sense in the world. Now, I don't know how many credit union board chairs would say that, but that's what we're talking about, the leadership.
I think leaders are supposed to ask hard questions, right? Like, I had the great fortune of working for Chuck Purvis at Coastal. And one of the things Chuck would do is he would ask really hard questions. He didn't have solutions yet. He just asked a really hard question, like, how do we solve that problem? And then he would let trained people who are in industry figure out how to solve that problem. And I think that's where we need, as an industry, we need a mechanism, a forum. We need some kind of way of just asking those really hard questions. I don't have the answer for that, but Jeff does, or Jeff plus Omar does, or Jeff plus Omar plus Jenny do. You know what I mean? Like, that's where we need to keep having those conversations about hard things. And, as I've gotten older, because my 30 years didn't start when I was 4, actually. I don't count that time frame. But as I've gotten older, one of the things that I try to do is I try to just ask more hard questions, right? And challenge assumptions that are underlying some of the decision making that we do. And I think if we have enough people doing that, and we can drive toward answering some of those challenges, and we have the courage to try that, I think we can be successful and build that strong foundation for the next great era of credit union.
It's the underlying passion for what this industry does and the value that it brings, and that's not going to be brought by other industry players that don't have the not for profit, but for service mentality. It's critical that this is figured out. These discussions and challenging questions are just the beginning of what needs to happen, so that people think a little bit differently. And maybe the structure that builds the knowledge for how this is solved is not a traditional credit union structure. Maybe there needs to be a different structure that has a completely different incentive plan that is more long-term, more equity-like. Just thinking differently, bold leadership, that's what we're here to talk about today. We're going to circle back on this subject many times in the future. I am in awe of these 3 gentlemen. You did a spectacular job. Thank you for your service to the credit union industry, and thank you for joining me today.
Thank you. My pleasure.
Thank you, Doug.
That's all the insider credit union knowledge we have for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.